Welcome to the Deep Dive. We're your guides for the series Navigating a Business Model.
Yeah, in this series, we're breaking down those big strategic concepts, the core parts of any business model, into what we like to call atomic units.
Exactly. Small, digestible insights, really designed for entrepreneurs, for leaders, anyone needing clear, actionable takeaways.
And today we're diving into episode 22, Key Metrics, Beyond Vanity.
Vanity metrics, a classic trap.
It really is. Our mission today is simple. Figure out the difference between numbers that just, look good and the metrics that actually build a sustainable business.
It's about shifting your focus, right?
Yeah.
Away from the fluff and onto what genuinely drives financial health and helps you make smart, data-driven decisions.
Couldn't have said it better.
You see it all the time. Companies with these huge, impressive-sounding numbers, but underneath, they're actually struggling. Like, remember that recruitment platform example, the one that just exploded?
Oh, yeah. Wild story. They went viral, instantly. Pulled in something like 33 million daily active users.
And almost $50 million in funding in under 2 years. I mean, talk about looking like a rocket ship, right?
Totally.
Yeah.
But that's the cautionary tale, isn't it?
Right.
They were so focused on that number, the daily users, a classic vanity metric,
Right.
that they missed the bigger picture.
Yeah.
The sources say they were losing users just about as fast as they gained them.
Ouch. And angering everyone in the process.
Exactly. So that rocket ship, it became a meteor until they fell to Earth. It just shows how dangerous it is to mistake that surface shine for, actual business health.
And that's why we're here today, to help you, our listeners, find those hidden gears, the things that really drive growth, sustainable growth, not just the flashy numbers that grab headlines but don't actually, pay the bills.
Let's do it.
Okay, so first things first, let's really unpack this idea. Vanity versus operational metrics. We kind of know what vanity metrics feel like, but how do the sources formally define them? What are these things that look good but might be leading us astray?
Well, the sources describe them pretty clearly as surface-level metrics. Often they're those big, broad numbers like total downloads or maybe website page views that, they impress people.
They look good in a pitch deck.
They absolutely do.
Yeah.
And look, they can be useful sometimes, maybe for getting some initial buzz, attracting partners, maybe even getting that first bit of funding. They put you on the map, so to speak.
There's always a but.
Right. But the crucial thing is, they don't tell you much about the health or the operational reality of the business. You can look amazing on paper, tons of users, but be fundamentally broken underneath.
Oh, okay. So if those are the misleading ones, what are the metrics that do give us real insight? What do the sources call those?
They call them clarity metrics or, operational metrics. I like clarity metrics.
Me too.
Because that's what they do.
Yeah.
They provide clarity. They're the hidden gears that drive growth.
Okay, like what? Give us some examples.
Sure. Think about things like how many minutes a day your product actually gets used, active engagement, right? Or maybe how long it takes for a customer to get service resolved.
Things that measure actual value or efficiency.
Exactly. The core idea here is that these are the metrics you should use to really solidify your competitive advantage because they give you actionable insights. They show you what's working, what's not, and where you need to focus your efforts.
It seems so obvious when you lay it out like that, but clearly it's easy to mix them up. Why is confusing these two just so dangerous?
Well, the source puts it bluntly. Confusing the two types of measurements can be a recipe for disaster.
Disaster.
Strong word. It is, but it fits.
Yeah.
Companies can get so enamored with vanity metrics, so caught up in looking good, that they just fail to build a viable business strategy underneath it all.
Right.
That recruitment platform, again, perfect example. Massive funding, huge user numbers.
That's great.
But it masked a fundamental flaw. A flaw you could only see if you looked past that shiny user number. They had the appearance, but not the substance. Like a fancy car with no engine. Looks cool, but it's not going anywhere.
Okay, that paints a clear picture. The flashy numbers are tempting, but they won't keep the lights on if the core business isn't sound. So, to avoid being that meteor, let's dig into some specific operational metrics, the ones the sources say are vital for, real financial success and making those smart, data-driven calls for the long haul.
Absolutely. Let's get practical. We should definitely talk about customer acquisition cost, CAC.
Yeah.
Customer lifetime value, LTV.
Crucial.
Gross margin. And, of course, churn rate.
Big four, basically.
Pretty much.
Yeah.
And the goal here, really, is to help cultivate that mindset shift.
Yeah.
Thinking about long-term sustainability, not just those quick, superficial wins.
Okay, let's start with CAC. Customer acquisition cost. Most people have heard of it, but Why is it so fundamental?
Well, the sources put it really powerfully. They say customer acquisition is oxygen to a startup
Oxygen. Well, okay, unpack that.
Right.
Why is it that critical, especially early on?
because it's foundational. Knowing your CAC tells you the absolute maximum you should be willing to spend to acquire an additional customer. Think about it. If it costs you more to get a customer and serve them than the revenue they bring in.
You're losing money on every new sign-up.
Precisely. You're not just burning through investment cash, you're actively digging a deeper hole with every success. That's how you become that meteor we talked about. It's unsustainable by definition.
A business model built on quicksand, like you said. So is there a good example of a company that really got this right? Optimize their CAC smartly?
Yeah, the Dropbox story is fantastic here.
Mm-hmm.
Initially, they tried the usual stuff, Google Ads, BD deals.
Really expensive routes.
Right. And they found they were not attractive options. Probably too expensive, didn't scale well. But here's the clever part.
Yeah.
They pivoted hard towards viral marketing.
The holy grail.
Kinda, yeah. Because their customers were naturally spreading the word. Dropbox was useful, people shared it. This dramatically lowered their CAC.
So growth fueled itself, more or less.
Exactly. They went from 1 million users to 4 million in less than a year.
Yeah.
Basically, without spending on paid marketing channels. And get this, they were so focused on it, they dedicated 30% of Dropbox's engineering resources just to optimizing that viral loop, that customer acquisition funnel.
Wow, they literally engineered low CAC into the product.
That's a great way to put it. They turned their users into their best and cheapest sales force.
Okay, that's a powerful lesson. So if CAC is the cost in, then LTV, customer lifetime value, that's the value out over time, right? The other side of the equation.
Precisely. LTV is the total revenue you can reasonably expect from a single customer over the entire time they stay with you. It's about managing customers based on their customer lifetime value. It forces you to think beyond that first transaction.
Right, thinking about the relationship, not just the date.
That's where the real value often is.
So how do LTV and CAC work together? Is there like a magic ratio we should aim for?
There isn't one single magic number, but the ratio between LTV and CAC is incredibly important. The sources mention combining conversion funnel data with other metrics to estimate the average lifetime value, LTV, not net, of the average customer acquisition cost, CAC.
So LTV divided by CAC, basically.
Yeah, essentially. That LTV to CAC ratio, it's like your business model's vital sign monitor. It tells you if your unit economics work. Are you actually making more from a customer than it costs you to get them?
It's like an early warning system.
Definitely. And it's a key signal to investors, too. A healthy ratio means you can reinvest in growth sustainably. Every new customer becomes fuel, not a financial drain. Plus, knowing your LTV helps you decide which customers to acquire and how to acquire them. You can focus your efforts on the segments that bring the most long-term value.
Makes sense. Focus your acquisition spend where the long-term payoff is highest.
Okay, so we've got customers, we know their value, but we still need to actually make money on the stuff we sell them. That's where gross margin comes in, right?
Yeah.
How does that fit into the sustainability picture? Gross margin is absolutely fundamental. It's the profit you make on your core product or service after you account for the direct costs of producing it. Think cost of goods sold.
The basic profitability of each sale.
Exactly. And your pricing strategy plays a huge role here. The sources say optimal pricing depends on the market's price elasticity of demand, how much demand changes with price, and the relative size of the margins inherent in that industry.
So what customers are willing to pay and what it costs you to deliver.
Right. And without a healthy gross margin, you simply can't cover all your other costs, R&D, sales, marketing, admin, let alone invest in growing the business. It's the engine generating the cash to run everything else.
Can we see an example where maybe a company's operational choices really boosted their gross margin in a clever way?
Sure, the Zara example is quite telling.
Yeah.
They have one of the highest gross margins in the notoriously tough apparel retail sector.
How do they manage that? Fast fashion usually means tight margins.
Well, it's how they do fast fashion. Their small production runs create scarcity. Things sell out fast. This encourages people to buy quickly, often at full price.
Less need for markdowns.
Exactly. That strategy minimized the number of unpopular items so markdowns are rare. Their operational choices, small batches, rapid turnover, tightly controlled inventory, directly result in a higher gross margin. It shows how deeply operations and strategy connect to this key metric.
That's really smart. It's not just about selling clothes cheaply.
Not at all. And digging a bit deeper on this, the sources also bring up something called contribution margin analysis.
Okay, what's that? Sounds a bit more technical.
It is, but it's powerful. It's presented as a better way to think about pricing than just adding a standard markup to your costs, cost plus pricing.
Right.
Contribution margin focuses only on the costs related directly to a specific pricing decision. So the variable costs. It helps you understand how much each sale actually contributes towards covering your fixed costs and generating profit.
So it helps you make smarter pricing changes.
Precisely. Yeah. It's crucial when you're thinking about changing prices, maybe responding to a competitor. It encourages different departments, sales, finance, production, to work together.
Cross-functional?
Yeah.
Yeah.
And leads to pricing that actually aligns with the overall corporate goals and strategies. There was an example of an IT company, software for opticians. They used this exact approach to figure out how to handle competitors who were undercutting them on price. Without just slashing their own prices and killing their profitability, they understood their true contribution per sale.
Very useful. Okay, last of the big four. Churn rate. We've acquired customers. We know their value. We're making margin. But we need to keep them right. That's churn.
Absolutely. Churn rate is simply the percentage of customers who stop doing business with you over a specific period. Stop using your service, cancel their subscription, whatever it means for your model.
It's the leaky bucket problem.
Exactly. It's the direct measure of customer retention. And the sources really emphasize the importance of customer retention. Why? Because acquiring a new customer is almost always way more expensive than keeping an existing one. Sometimes 5 times more, even 10 times in some industries.
Wow. So high churn just kills your profitability, even if your CAC looks okay.
It absolutely demolishes it.
Yeah.
You're constantly spending to replace the customers who are leaving. It's exhausting and expensive.
So how do you track it? And more importantly, what do you do if your churn is too high?
Well, a simple starting point the sources suggest is just looking at activity. If a customer has not made any purchases in the last 6 months, maybe they've churned, but just measuring isn't enough.
Right.
You have to diagnose reasons for churn. Why are people leaving? Then identify churners, maybe predict who might churn, and finally, create programs to target them, to try and win them back or improve their experience before they leave.
Proactive retention.
Exactly. Because if your churn is high, it doesn't matter how good your acquisition engine is.
Yeah.
You'll never build a stable, growing customer base. You're just pouring water into that leaky bucket faster and faster.
Okay, so stepping back from the individual metrics, it really feels like the overarching theme here is focusing on what truly measures the underlying health and, crucially, the sustainability of the business. Not just the stuff that looks good for a quarter or gets you a nice headline.
Precisely. It's about building that mindset, that culture, that values clarity over vanity. Remember, the whole point of understanding your business model is seeing how management choices lead to consequences.
And these operational metrics are how we measure those consequences.
They're the best way. Doing a systematic sensitivity analysis, as the sources call it, helps you pinpoint the critical success factors. Which levers, when you pull them, have the biggest impact on your cash flow, your profitability, your long-term survival? It shows you what really matters.
And this all comes back to making better decisions, right? Moving away from just relying on gut feeling.
Totally. It's all about data-driven decision-making. The sources stress this again and again. Look at IBM. Even a giant like IBM used key milestones and meeting important metrics to track its internal ventures.
So they didn't just throw money at ideas.
No, they constantly re-examine their critical assumptions using insights gained from the data. It shows that even established players need this rigor. You have to constantly test your assumptions against reality, against the real metrics, to avoid falling into that vanity trap.
Okay, this has been incredibly insightful. So to wrap up for our listeners, if you want to navigate your business model effectively, build something that lasts, here are the key takeaways from today's deep dive.
First, really get clear on the difference between vanity metrics, those surface-level numbers like raw user counts, and operational metrics like LTV, CAC, gross margin, and churn. Know which is which.
Second, prioritize tracking and optimizing those operational metrics. These are the hidden gears. Understand how they connect directly to your financial health and your ability to survive and thrive long-term. Focus your energy here.
And third, use the data from these critical hidden gears to make genuinely informed, sustainable decisions. Don't get distracted by what sounds cool or generates buzz. Focus relentlessly on what builds real, enduring value.
Well said.
And maybe here's a final thought to leave you with. We live in a world drowning in data, right? But the real competitive advantage isn't just having metrics. It's knowing which metrics truly light up the path to sustainable value.
So the question for you listening right now is, as you look at your own business, what hidden gears are you really focused on? And maybe more importantly, what critical assumptions are you actively challenging and re-examining with cold, hard data to make sure you're building a rocket ship, not just another meteor?